course, we're counting down to that jobs data stateside. What are you expecting? Could we get some good news, which will spell bad news for the markets, or could we get some bad news, which may be good news for the markets?
But I think it's always tricky exactly for the reason which you laid out. To be honest, I mean, the job market is the one bright spot in the US economy. And to some degree, that's because it does tend to be a bit of a lagging indicator. And I suspect we'll get a number that's sort of somewhere in the middle. But for markets, we think that may only be, a bit of a temporary flash, regardless of whether that's a positive or negative take. The real challenge really for markets is when we get to the inflation number, because in our view, at least when you think about what's driving markets today, in terms of expectation of Fed policy, it's really inflation that's driving it. And look, we're of the view that, in a central scenario, at least, we do expect, the inflation to start slowing within the second half of this year. And I think the key one there is that we get the slowing on a month-on-month number basis, regardless of what the headline year-on-year number does. But I think that's really going to be the key one, because the risk is really if we don't see a slowing, that's the scenario in which markets start to worry.
And of course, we've had more hawkish Fed talk. Keeping rates higher for longer seems to be the mantra. What will this mean for the FX space, and particularly these emerging market currencies, given that there is an expectation that Asian currencies could continue to weaken for another quarter, if not more?
Well, it's definitely a challenge. And I think part of the challenge is they all come back to being the same trade, which is, what's your view on the US dollar? Because, most emerging markets are through cycles. This wouldn't be the first time, is that when you have a stronger dollar, emerging market assets, including the currencies, tend to be under pressure. But, in our view, I think that's obviously one key challenge. And I think a lot of our currency picks in the shorter horizon, over the next 1 to 3 months, we are sort of positioned for a stronger US dollar. So from a majors pairs, that's sort of our preferred positioning, or of course taking very sporadic picks in non-dollar pairs. I think that's really the way we're approaching FX markets, because for EM specifically, it tends to be a bit more of a one-way trade. But that's part of the reason when it comes to EM, we still think more than FX markets is the equity market in Asia, which may be a better longer-term position, because while you do have this headwind from a stronger dollar, it impacts EM equities as much as EM FX. I think there at least you're able to buy what we see as good value. So yes, the risk of further downside is really the next 1 to 3 months. But I think when you start looking at Asian equities, mainly driven by what we see in value in China, I think that's really the long-term opportunity there.